green across the board. Dow's at the highs of the day. S&P 500 on track for a record close. Today's CPI print showing inflation rising again, slightly hotter than expected, but clearing the way for investors to resume buying high-flying tech names. That seems to be what's happening. Joining me now, Post 9, Mark Okada of Sycamore Tree Capital Partners. Nice to see you in person.
It's good to be here, Scott.
You said, you had a big smile on your face. You sat down and said it's weird to be bullish.
Yeah.
But you are.
I am. Once they decided to turn on the spigots on that pivot, and you got Yellen doing the same thing, markets awash in liquidity, streets wide open. It's a busy time. There's a lot going on.
You got a lot, it's picking up,
yeah.
You said, as you sat down. In what respect?
Well, supply has been the thing that I've been thinking about a lot. I mean, you gotta learn from things. What we learned from COVID, and we learned from the inflation that came out of that, it was all supply. If you got the supply wrong, you got the housing market wrong, you got kind of everything. The Fed got it wrong. I mean, they thought it was transitory. They didn't understand the supply side. So I've been thinking a lot about supply, and from a supply standpoint, labor seems to have topped out. I mean, I'm in Texas. We got a lot of people came over the border here. A lot, but I don't think there's going to be a labor shortage anytime soon. So that's kind of off the table as an issue. And the other parts of supply is really about treasuries, and then we have the CPI print, and the other things about M&A. M&A is something that I think is going to continue to start to rebound hard.
Wow, I cannot remember a time that we've spent together where you've been this bullish. You say this is the most bullish we've been on overall risk, at least in credit. You're talking about specifically credit? Because, I mean, that's your wheelhouse.
Sure. It is weird because credit people see the world as half empty. But if you're going to have this big of a move in what the Fed's doing as far as leaning against the economy and leaning against markets, and then you have this dynamic where I think Yellen, as a former Fed chair, has kind of politicized the whole situation, and we are in an election year, and Biden's approval rating is not good. So I don't think there's any way that they let a recession happen anytime soon. So credit people care about bad things like recession. If recession's not in the cards and we're making 9-10% in higher quality credit, let's go.
Yeah, but I mean, the Treasury Secretary, she's not the one responsible for cutting interest rates.
That's right. That's right. But on the other hand, look at what she did in flooding the world with T-bills in December. And look, they've forgiven $130 billion of student debt. There's more levers to pull on the other side if things get weak. So I don't really think we're going to have a cycle anytime soon. I wish we would.
Really?
It'd be kind of fun to have.
But what do you think? Are we mid-cycle? Where are we?
Well,
you thought maybe before we were late cycle.
And we are long cycle, very long cycle. But again, I think what happened in November, December actually resets the clock a bit on this economic cycle, and it's hard. We don't see broad weakness anywhere we look. Consumer, capital markets certainly, and there's plenty of flows. And every time I talk to people on the street, it's like, let's go. There's been this huge drought of M&A. We haven't seen 22, 23, probably some of the worst years for M&A in a long time. Mm-hmm. If that bounces the way we think it's going to bounce, there's going to be lots to do. New issue is always a good thing to play with as opposed to trying to figure out secondary. So, and it's just starting. It's just getting going. I mean, we're doing a lot of dividend financings and things like that aren't that interesting. But once this sort of M&A sort of actually gets going, I think we're going to see a lot more deal flow and good deals.
Wow, I mean, when the credit guy is all bulled up, that makes me a little nervous.
Yeah, you should. Definitely a sell signal.
Yeah, a sign of the top.
Yeah.
Sign of the top. When do you think we get the first rate cut? Because I mean, it sounds to me as though that is really the overriding factor for you. That we had a trend change, right? The Fed pivoted, and now it's don't fight the Fed and don't fight liquidity. Don't fight the supply.
Yeah.
Of everything.
So last time he had me on, I said there's no. They were pricing 7 cuts at that time, and I said no way. We're in the higher for longer camp. Mm-hmm. I think there's a good chance that they don't hike at all this year, and I actually think that's probably a good thing.
Don't cut.
They don't cut at all, and maybe some people are talking about maybe one hike. That would be upsetting a bit. But
that seems really unlikely, right?
That's an outlier case. I think the case where they don't cut it all this year is still an outlier case. I mean, the Fed has pretty much telegraphed that they're gonna go at some point.
They sure did, right? Jay Powell, the Fed chair, was dovish last week on the Hill, don't you think?
100%. And so I think they go in maybe June, but I don't think markets care. Today is a good point. Like CPI comes in hotter. This market's all-time high. This is not a Fed-centric market right now. It's really about liquidity and momentum, I guess. But I'm not an equity guy, so don't ask me any of those questions.
Well, why do you think that a second wave of inflation is the base case? You made that statement to our producers. I mean, be careful which metric you look at, because PCE is closer to the Fed's target than CPI, and this PCE matters more, doesn't it?
It does. It is, because PCE is data, CPI is survey, right? One makes a lot more sense in this kind of world.
Well, so are we going back towards
but so history tells you that it's rare to have one peak in inflation. That usually there's another hump somewhere down the road. I think that's coming at some point. I don't think it's right now, but if you were in an election year, we took financial conditions very, very easy. That's why I'm talking about M&A. That's why I think that continues to go. That's going to be very accretive to the big banks, the money centers, but it's going to take a bit. This bout is over. We're definitely, from a supply standpoint, we don't have the labor sort of pressure, I think, on that inflationary dynamic.
Right, wage pressure's coming off a little bit. And this was mostly, wouldn't you suggest, a pandemic-induced supply shock?
Yeah, 100%. Because
it's not going to happen again.
Right, because I hope not. I hope we don't lose a lot of people again from a
I'm not saying
pandemic.
ever, but I'm saying we're not going to get a pandemic-induced supply shock to cause a second wave of inflation.
Right.
And then some of the stimulus that we did out of Washington, now we probably did too much, but that still is going to run off.
The economy is strong. I think if you were sat at my desk and you saw all the things that were happening, you'd think, wow, the GDP numbers are probably a little light. So if we start to heat up in here, you could certainly see another bout of inflation. But the thing that's a little more concerning, Scott, is the supply of treasuries, right? We've got to issue 24%.
Oh, yeah. You didn't even talk about the deficit.
Yeah. Oh, no. Come on, I'm bullish. I don't want to talk about that.
All right, we'll save it for the next time. See how bullish you are the next time we see each other. Be well.
Thanks, Scott.